I'm Michael Thornycroft, Corporate Communications Manager at Vanguard Australia. Today, I'm joined by two members of our investment strategy group to discuss some of the key economic and market trends impacting investor portfolios. Qian Wang is our Asia Pacific Chief Economist, and Matt Tufano is our local economist. Welcome to you both.
Thank you.
So each year, we release Vanguard's Economic and Market Outlook, which covers all of the key themes impacting the economy and the markets globally. So with Qian and Matt here today, we thought it was a great opportunity to check in with our outlook and see if there's been any changes. So our 2018 outlook broadly noted muted growth with the potential to surprise on the upside. Has there been any change in this view?
Well, I remember earlier this year what we said is that it's not the fundamental that's vulnerable. It's actually the financial market, right? So we're expecting the return of volatility. Well, so far, when I look at it, you do get a lot of volatility in the financial market. But when you look at the economy, it was pretty decent, right? We still get, over 3% global economic growth, some upside surprise from the US, some downside surprise from maybe Europe and Japan. But overall, economic growth is decent. Inflation gets higher. Central bank continued with gradual normalization process. But we do see a lot of risk on the policy, political fronts, trade tension really start to escalate. So those are the things leading to, volatility in the financial market.
And Matt, has any of this information that's sort of come up in the first half of this year been of a surprise in terms of our outlook and what we expected?
Not really, Michael. We started the year, as Qian mentioned, thinking that the financial markets bore more of the risk than the fundamental economy. So what we've seen on a fundamental level is things have played out largely in line with the view that we had at the start of the year. Not many surprises to that, other than perhaps it's been a bit stronger in some markets, particularly the United States, where we've seen inflation and the unemployment rate come out a little bit more positively than we might have even expected. But other than that, everything seems to be evolving as we had previously thought.
Speculation around interest rate moves continues as we watch what's happening in the US with the Federal Reserve and the RBA. Matt, are we still expecting the US to raise rates again this year?
We think that the Fed is probably going to raise the federal funds rate at least 2 more times this year. That's a change from what we had been saying earlier in the past, and it largely reflects that the US economic story has been a bit stronger than even we had expected. So we'll probably see 2 more interest rate hikes, largely in line with that strong inflation, really low unemployment, and improving wage growth, which is starting to materialize more and more. And the Fed operates in this unemployment-inflation dynamic. So as long as that story is still strong, we feel confident that interest rate rises are definitely on the table. Now, when we look at Australia, for example, I think that's where the story gets a bit more nuanced. Because even as recently as a few weeks ago, we had seen that there was a pretty strong consensus that had formed that there might be a raise by the RBA before the end of this year. Now, market consensus has pushed that expectation out to sometime in 2019, kind of different points along the curve. And we look at the main drivers for that, it's been a combination of factors around housing prices are starting to cool down, particularly here in Melbourne and Sydney. We've seen growing concern that credit conditions might start to tighten. So there's just been a general apprehension in the market of can the RBA really achieve an interest rate hike at this time? So we see that, and our team has been debating, well, is there a chance that the RBA might go earlier than the market might expect? So if we would put any risk to that view of an RBA hike sometime next year, it might be that it's earlier than the market expects. That's as long as the growth story holds up, and as long as fundamentals remain strong, that's the main risk that we see for the economy here.
So while we're on the topic of interest rates, we're always asked to discuss the role of fixed income in a portfolio and at times defend it when we're in a market situation where we expect rates to rise. So given what we've just discussed, what does this mean for the role of fixed income in an investor's portfolio?
Look, there still is a role for fixed interest in the portfolio. You have to think of it as a diversifier for equity risk. It is nice when bonds do provide us a return. It's always nice to see that. But their real purpose is to buffer against equity market volatility. Time and time again, whether interest rates are moving up, down, or sideways, that is the defining feature of fixed interest investing. And so what we try and counsel a lot of our clients on is to just think twice about shortening duration. That's kind of where you see as well, maybe I don't want to hold bonds with a 10-year maturity. Maybe I want to bring them inside of 5 years or even shorter to 3 or 2 years. That actually exposes you more to interest rate losses because you're giving up return because as interest rates are rising, the income that you can bring in from that additional yield also increases as well. So if you're shortening duration, though, you're leaving some of that expected return on the table. So while the conversation always naturally, it's our human instinct to say, well, we should shy away from this. We actually say, no, second guess your instinct. Maybe you want to just lean against the wind for a second.
One of the significant news stories impacting markets is the trade tensions between China and the US. Qian, are you able to shed any light on what economic impacts this might have?
Right. I would say if we name any surprise this year, I would say the escalation of the trade tension is definitely one of the surprise. I would say, in fact, when you look at the China and the U.S., right, we talk about this as a potential trade war, trade friction, but in fact, I would say there's a lot more than just the trade. There are something that's more fundamental. About the economic system in China. So I would say when we look at the trade deficit, U.S. cannot shrink their trade deficit by imposing higher import tariff from China. U.S. have higher trade deficit because you save less, you spend more, especially with your higher, fiscal deficit, given their fiscal stimulus. The current account deficit will be always there. It's probably just not from China, but it will be probably from other countries like Vietnam or India. Right, so it's not about trade, but I think between U.S. and China, there is something more, is that U.S. is using the trade war, the tariff, as a tool, as a measure to pressure China to change something more fundamental of the economy, live up to the WTO promise, increase your intellectual property protection, lower your government support or intervention to the economy, change your economic system, be more open, be more market-oriented. So in that sense, I would say there's a lot more, negotiation or that China and U.S. need to, come to.
Earlier this year, global markets went through periods of volatility. Obviously, this caught the attention of investors, and it's something we get asked about a lot. Should investors be expecting more volatility through the end of this year?
Well, what I say, after so many years, after the global financial crisis, people are very much enjoying the Goldilocks situation. Moderate growth, low inflation, central bank easing the monetary environment, and that leads to very low volatility in the market, right? So, but what we are saying, that's why we say, 2018, that's a year you should expect the volatility to come back, especially along the gradual normalization, less liquidity in the financial system, and also with all the risk on the economic, political, and policy front, right? So I would say, the kind of low volatility in the past several years, we think that's not normal, right? So you should get used to higher volatility in the financial market, given all the uncertainty, right? So you should, be prepared for that volatility.
So investors are dealing with a constant stream of information about the economy, about markets. What should they be considering when making investment decisions?
Yeah, I'd say it comes down to start with 2 Ds, Michael: discipline and diversification. Discipline, one of our key investment principles. We encourage all investors to kind of stay the course and to maintain a cool head. So investors, it's time to revisit your asset allocation, revisit any active positions or deviations you're making from benchmark, and just ask yourself, why did I put these positions on in the first place? And do they still make sense? And consequently, if I were to be wrong, how would I feel if I were wrong? And this is something that we've seen with a lot of investors, particularly some that have a large overweight in some asset classes, is being afraid to kind of let go of the steering wheel a little bit. That's what diversification can kind of feel like. Why am I reducing my holdings of something that's been performing really, really well for an extended period of time? How would you feel if that asset class was suddenly at the bottom of the league table and had some pretty big negative numbers attached to it? So diversification kind of trades off some of that extreme wins or extreme losses for being able to sleep at night. I know, at least for me, that's how I sleep at night, knowing that I have balance in my portfolio and that no matter what happens, I know the asset classes that are going to perform well, and I can kind of maintain my cool head, especially in challenging times that we're seeing now.
I think there's a lot of market information. Sometimes we have too much information, right? So, but as a long-term investor, I think when we are, we need to understand the market volatility, why we have this kind of market volatility. But I don't think we need to, make any changes to our, portfolio based on those short-term information. Because after all, we are long-term investor. We have our long-term goal to achieve. So I think in this kind of a scenario, step back and think about what are the structural factors that are really shaping our long-term future. What is determining our long-term goal? I think when you take a step back and you think about the long term, then you have three things: technology, globalization, and demographics. Those are the critical trends that's structurally shaping our long-term outlook. So those are the information for the long term.
Thank you so much. We hope you found this information insightful. If you'd like more information from Vanguard, please visit the research and commentary section on our website, or you can follow us on LinkedIn, Twitter, or YouTube. Thanks again.